With interest rates staying higher for longer, a lot of investors are wondering, should you go for a traditional TLT ETF or switch to the income-focused TLTW? Today I'll break down exactly how they work and which one I think will perform better in 2025. Now let's cover how TLT and TLTW are built, the pros and cons of each, and which one fits for different types of investors. So let's go over TLT, which is the iShares 20-year Treasury Bond ETF. And if you're not familiar with iShares, it is a company by BlackRock, which is one of the largest institutions. If we can see and sort by ETF providers, BlackRock is the largest one with $3.1 trillion in total assets. And they also have the most funds, 468. But with TLT ETF, the 20 plus year Treasury Bond ETF, it holds very long US government bonds. So this means it's very sensitive to interest rate changes. You really want to buy this ETF if interest rates fall, because when interest rates do fall, you are going to see a huge surge in price. And that is going to be a very good investment for your money. Because right now interest rates are very high. So a lot of people are thinking that in a few years, interest rates have to come down, and that's really when people are going to see a very high return on their investment on TLT ETF. So if we take a look at the 5-year chart for TLT ETF, it is down about 50%, and that's because the 20 plus year Treasury bonds have high interest. It's been steadily increasing. It's currently about 4.5 to 4.6%, which is an insanely high interest rate. And that is really why this ETF is down so much. So if those interest rates end up falling, this ETF is going to have a very high surge in price. But for now, a lot of investors are actually buying this ETF, and that is because we have a monthly paying 4.24% dividend yield. So this is very good for some cash flow. It's very similar to a high yield savings account where you're getting paid interest every single month, but this is going to have a higher dividend yield. So this is a great alternative to a high yield savings, except it may be a little bit more volatile because it's going to increase and decrease with the share price. And of course, you do have to pay taxes on those dividends as well as the interest on a high yield savings account. And if we take a look at TLT's holdings, very long-term dated treasury bonds, we can see 2053, 2046, very long in the future bonds. So TLT is your classic long bond bet. If interest rates drop, you win big. But if interest rates stay high or go even higher, this ETF will drop in share price and you will lose some money. Now let's go over TLT, which is the iShares 20 plus year Treasury Bond Buy Right Strategy ETF. Now this is a very similar ETF to TLT, but it is going to actually sell options contracts against TLT. So it does hold TLT ETF, but it does some option strategies against that ETF, and that is going to provide some additional income from the option premiums. So if we take a look at why TLTW, of course, we have the potential for enhanced income. It may provide enhanced income compared to traditional US Treasury bonds by selling monthly covered call options. And we'll go over that a little bit more in detail later on. It does have diversification. The fund may outperform in periods of rising rates. And of course, we have easy access. It's an actively managed fund. We have a fund manager doing all this work for us, which is great. And the objective of this ETF is that it's going to seek to track the investment returns of an index that reflects a strategy of holding the iShares 20 plus year Treasury Bond ETF, which is just going to be TLT. And then it's going to write or sell 1 month covered call options to generate income. And that is going to be distributed to us in the form of dividends every single month. So if we take a look at the holdings of TLTW, of course, we have TLT as its main holding, and then it does have some cash, and then we do have our call option right there. So it's going to be selling call options on the TLT shares that we have in our portfolio on this ETF. If we take a look at TLTW, past 5 years, well, this ETF only has been out since 2022, But in this market, it has been dropping over time, and that is because these long dated bonds have been rising. So in turn, this ETF is going to drop. However, compared to regular TLT, take a look right here. We have a dividend yield of 15%. And this is going to be paid out monthly, as I mentioned earlier. So this is a really high cash payment. We can see the dividends every single month. You're pretty much going to be able to buy an additional share of this ETF every single month. And if you turn on dividends reinvested, you can really increase your share holdings exponentially. And it's able to provide a 15% dividend yield because it's selling calls on TLT. Covered calls generate extra income in the form of option premiums. But the trade-off is you're going to get a higher yield, but your upside is capped. So if TLT rallies, goes absolutely to the moon, you are not going to see those gains on TLT because of those call options. What we're going to see instead is a steady, slow upward movement if TLT goes very high. So if someone is looking for a little bit more stability, don't want more volatility, TLTW is a great choice. And since it's at a very cheap price right now, I think it's a great buy to add to your portfolio. And even though this chart looks very scary, it's down 40% all time. We do have to look at the total returns because we are receiving a 15% dividend yield paid out monthly. So with those reinvested, it's not as scary as it looks. So if we go to the total real returns calculator and we set the date year to date, we can actually see that TLT and TLTW are actually positive for the year compared to the S&P 500 index, SPY, which is actually down 7%. And what's interesting is that TLTW actually has a higher total return year to date than TLT, the regular ETF. And that is because of those dividends that we are seeing being reinvested. Now, while it's not a significant increase, 1% does add up over time. So it's a great alternative to TLT if you're considering treasury bonds. And especially for income-focused investors, TLT really aligns with a lot of people's strategies with covered call ETFs paying out monthly dividends. But of course, if interest rates fall, things can change drastically. TLT may outperform if interest rates just absolutely tank. So if interest rates start falling aggressively, TLT is going to be the big winner. But if rates stay elevated or just decline slowly, TLT is going to outperform TLT. TLTW is going to outperform TLT. And of course, this is very hard to time exactly. It depends on recession risk, inflation, and of course, Federal Reserve decisions. Personally, I'm leaning towards TLTW. I'm more of an income-focused investor, and having those covered call option premiums is going to help allow more dividends being reinvested into my portfolio. But another good strategy is to buy TLTW, and then when you receive those dividends, pour that money into TLT. That way you're getting exposure to both of these ETFs. So if you want income now and you don't mind the capped upside potential, TLTW is a great choice. But if you think that interest rates are going to fall hard, you want to buy TLT. That's really going to see some huge returns in the future. Or of course, as we mentioned earlier, you can split into both of these ETFs for diversification. So let me know down in the comments which one fits your investing style better, TLT or TLTW. Drop a comment down below. I'd love to hear your plan for 2025.